Hello everyone, welcome to my third presentation. This presentation is titled External Stochastic Control Strategies. So the strategies that we're discussing in this presentation can be thought of as a generalization or an extension of the strategies that I've discussed in my previous presentation titled Stochastic Control Approaches using OU process. So viewers who have already seen that presentation might be a bit familiar with the topics that I'll be discussing. So firstly, let me introduce myself. So my name is Vijay Nadipalli, and I'm currently working as a quantitative researcher at Hudson and Thames. I'll be joining the Masters in Computational Finance program at Carnegie Mellon University this coming fall. So yeah, let's look at the contents of the presentation. So firstly, I'll be introducing the paper that we'll be discussing. Then I'll go through step by step on how we can actually calculate the portfolio weights. And finally, we look at the results that can be obtained by using these models and the reference paper. So let me introduce the paper. So the paper is titled Optimal Convergence Trade Strategies, written by Mr. Liu and Mr. Timmerman in 2013. So as I mentioned before, this paper can be thought of as an extension of the papers that I've discussed in my previous presentation. So let's look at some of the shortcomings of the previous papers and how this paper addresses those shortcomings. So as you might know, in a typical convergence trade, two assets trade at different prices but have similar payoff with certainty at a future date. Some examples of convergence trades are merger arbitrage, which is a risk arbitrage, or pace trading, which is a relative value trade. The strategies for these type of trades, they conventionally consider taking delta neutrality positions. Although this consideration, it seems intuitive at first, as any future risks are offset between the pair of stocks. These type of strategies, as the Liu and Timmerman paper discusses, they will typically not be optimal. These delta neutral convergence trades did not exploit the short-term risk-return trade-off that exists, as they are built to only work on long-term arbitrage opportunities. So in this presentation, I'll be discussing the models which follow a generalized approach, which allow the weights corresponding to the stocks in the portfolio to move freely, along with looking at some of the shortcomings of the previous approaches. So let's get into it. So these are the strategies that we'll be discussing in this presentation. So the first strategy is the optimal portfolio strategy, which is an unconstrained strategy. And the second strategy, as the name suggests, is a delta neutral portfolio strategy where we have a delta neutrality condition. So for each one of these strategies, we'll also look at two co-integration processes, that is continuous co-integration process and the stopped co-integration process. So the continuous co-integration process is just a normal process that we look at generally. So it's basically it's also called a recurring arbitrage of opportunity, where we assume that arbitrage exists even after the spread reaches zero for the first time. So that's the continuous co-integration process. And the next process is the stopped co-integration process. So when do we use the stopped co-integration process? In some cases, the price difference between two assets in a convergence trade, they might disappear permanently after the spread between the two assets reaches zero. To capture this, a stopped co-integration process is used, where asset prices they follow a co-integrated process before the difference reaches zero, and the difference remains at zero afterwards. So a stopped co-integration prices can also be used to model the strategies of convergence traders who close out their positions when prices converge. So let's look at the setup of the problem and the assumption that we're making here. So firstly, in this paper, the authors, they model risky arbitrages under the assumption that individual asset prices contain a random walk component, but that pairs of asset prices are co-integrated. This model captures the presence of a mean reverting mispricing component, which reverts to zero in the long run. This mean reverting error correction term, it represents an expected excess return over and above the risk premium implied by CAP. This expected excess return is similar to a conventional alpha, except that it is time varying and it has a expected value of zero in the long run. This time variation property in alpha, it allows us to capture both the absolute mispricing, which is the abnormal expected returns over the CAPM benchmark values, and the relative mispricing, which is the relative prices of the two assets. So at short time horizons, time is too scarce for the arbitrage mechanism to be effective. So absolute mispricing dominates. But at longer horizons, relative mispricing, it plays a key role as price differentials between the two assets can be expected to revert to zero. And the optimal portfolio obviously can earn a profit by going long in the underpriced asset and going short in the relatively overpriced asset. So, sorry, let's look at some of the key assumptions of our model. So firstly, we assume that our model consists of a riskless asset with the rate of return small r. The second asset in our portfolio is assumed to be a market index, which is denoted by PMT. And we assume that it follows a geometric random walk. And some of the parameters of the random walk are the market risk premium denoted by mu m and the market volatility denoted by sigma m. And finally, the pricing errors in the model are denoted by xt, which is the spread between the two assets. And this xt is the same mean reverting error correction term that we have seen before. So the spread is calculated as the difference in the log prices between the two assets. So on the right-hand side, we have a plot which shows the spread between the Shell and Royal Dutch Petroleum pair of assets from 2003 Jan to 2005 Jan. As you can see, it is mean reverting. So the next assumptions we make are that the price processes, the two price processes we have here, P1T and P2T, we assume that they move according to these two price dynamics. So the first terms in this price dynamics is R plus beta into mu m term, which is given by cap m. It's a cap m relation. So the next term is the market risk term, which is common between the two assets. And the third term is the idiosyncratic risk term, which is obviously independent between the two assets. And it denotes the independent risk for each asset. And finally, we have this lambda into xt term, lambda 1 into xt and lambda 2 into xt. And I'll talk a bit about these two terms and the intuition behind adding these terms in the next slide. So another thing to note here is the parameters of these two price processes. They're assumed to be constant, and the Brownian motion that we have assumed here are mutually independent. So moving to the next slide, let me talk a bit about xt and the lambda parameters and how these are used. So obviously you might be wondering what these lambda parameters actually represent. So these parameters, along with the xt term, they represent the mispricing alphas, or to put it simply, they represent the amount by which each asset is overpriced or underpriced relative to cap m. This is also called the absolute mispricing of the asset. Also, they are the only source of mispricing in our model, and thus the only source of abnormal returns for our investors. Let me form some intuition behind this. So if lambda and lambda 2 are both equal to 0, for example, let's say, so the expected returns for price process P1 and P2 is basically R plus beta into mu, which is basically the cap m relation. And that means that there is no mispricing to exploit. So let's look at the interesting case. So let's suppose that lambda and lambda 2 are both not equal to 0. And in this case, suppose that minus lambda 1 of xt, this value is greater than 0. Let's suppose. So if this value is greater than 0, asset 1 has a higher expected return than is suggested by its risk, which means it has a positive alpha. And that obviously implies that asset 1 is underpriced. Conversely, when minus lambda of xt is less than 0, that means that the expected return, the expected return of price process P1 is lower than that is justified by its risk. That is, it has a negative alpha, and obviously that implies that it is overpriced. So this lambda naught xt parameter can be used to model whether the price process is underpriced or overpriced related to cap m. So let's also look at relative mispricing and how it can be modeled by xt. So xt, as we have seen before, is the difference in the logarithm of the price of the two assets. In order to keep the mispricing between the two assets stationary and the pricing error small compared to the price process, XT is modeled as a mean reverting process. We use the OU model here to model XT. This mean reversion XT captures the temporary nature of any mispricing. And one thing to note here is that if you go to the previous slide, you can see that we have an assumption here that lambda 1 plus lambda 2 is greater than 0. And this implies that XT is stationary. So if lambda 1 plus lambda 2, which is denoted by lambda x, if this value is greater than 0, this gives us that XT is mean reverting. So that's the reason why lambda 1 plus lambda 2 should be greater than 0. And that's a pretty critical assumption to make. So to sum up, absolute mispricing is determined in the short run by the conditional alphas, whereas relative mispricing is determined in the long run by the cointegration between the asset prices. So next, let's look at building the portfolio. So firstly, we assume that our portfolio consists of a risk-free asset, a market portfolio weighted by phi MT, the two risky assets weighted by phi 1T and phi 2T respectively. The dynamics of the total wealth of our portfolio, that is how our wealth process moves through time, is denoted by this particular equation given here. And here W of T is the wealth of a portfolio at time small t. And here phi 1T and these phi 1T, phi 2T, and phi MT are related to the market assets and the first and second risky assets in our portfolio. So next, so after we have calculated the wealth process, or after we have calculated the dynamics of the wealth process, next we can look at formulating the optimization problem. And before we can do that, we need to look at the investor preferences and what type of investor that we are looking at. So in this model, the authors assume that assume a power utility function defined over terminal wealth as the investor utility function. And our objective here is to maximize this utility function at terminal time capital T. So the investor value function is given by this particular equation. So using this value function, we can, and the stochastic control theory, we can calculate the HJB equation. And HJB equation can be shown in the form of PD, and that PD can be further calculated analytically to form the optimal portfolio weights. So here I have skipped some of the derivation showing how we can calculate the HJB equation and the PD, as that is not the focus of this presentation. That was intentionally skipped. But interested viewers can obviously go through the paper which goes through this derivation. So let's look at the finally calculated optimal strategies and how they are represented. So for the continuous cointegration case, we are actually able to calculate closed form solutions for the optimal portfolio weights, and they are given by using these two equations. The first equation gives us the optimal portfolio weights for the market index, and the second equation calculates the optimal portfolio weights for the first and second risky asset in our portfolio. And the plots on the right hand side, they give us the optimal portfolio weights for the first and second asset, calculated on the Shell and Royal Dutch Petroleum pair of stocks from 2003 Jan to 2005 Jan. Next, for the stock cointegration case, here we consider the price difference XT stays at 0 when it reaches 0 for the first time, so that it follows a stock cointegration process. This case is relevant for one-shot arbitrages, such as risk arbitrage in merger and acquisition, for example. Alternatively, this case also suits for an investor who decides to close out their position once prices converge. And that case can also be represented by a stock cointegration process. For the stock cointegration process, unfortunately, there is no closed form solution, which we can calculate from the partial differential equation. But we can solve the partial differential equation numerically and obtain the optimal portfolio. So finally, let's look at the delta neutral strategies, which are, as we have seen before, we have the delta neutrality condition. So again, in this case, for the continuous co-iteration subcase, we are able to calculate analytically the closed form solutions, and they are given by these two equations. The first equation gives us the portfolio weights for the market asset, and actually you can see here that this portfolio weight is constant with respect to time. And the second equation gives us the portfolio weights for the first risky asset. And as we assume a delta neutrality condition here, phi 1t is equal to minus phi 2t. So that's the delta neutrality condition. And using that, we can also calculate the portfolio weights for the second asset. And on the right hand side, we have plots for the first and second asset, the delta neutral portfolio weights for the first and second asset. So in this case, again, for the Stoch co-integration case, unfortunately, we are not able to calculate any closed form solutions. But we can solve the PD numerically to calculate the. So another interesting thing to note here is that the optimal portfolio strategy, it becomes equal to the delta neutral portfolio strategy when lambda 1 becomes equal to lambda 2. One interesting point is that different combinations of lambda 1 and lambda 2 parameters, they're likely to reflect the relative liquidity of the two assets. For example, if two high volume stocks are both traded in liquid markets, it is likely that the prices adjust equally rapidly. And so lambda 1 equal lambda 2, it holds as a good approximation. A good point in case here is the Royal Dutch and Shell shares traded on the Amsterdam and London stock exchanges, for which both lambdas are nearly equal. That is, lambda 1 is nearly equal to lambda 2. And we will see this in the results as well. So let's look at the results which are obtained by using these models. So firstly, let's look at the code that can be used to generate these results. So the optimal convergence class is under the stochastic control approach submodule inside ArbitrageLab. And in this case, for generating the results here, I have used the Shell and Royal Dutch Petroleum close prices from 1994 to 2004. And these are split into the training dataset and the testing dataset. The training set is inputted to the fit method, and the fit method calculates the estimated parameters for the price process that we have seen earlier. And on the right hand side, we can see the calculated parameters here, the lambda 1, lambda 2, and the other parameters. So using these parameters, after we calculate these parameters and using the testing data, we are able to calculate the portfolio weights by calling the respective functions for the optimal portfolio weights, the unconstrained optimal portfolio weights, and the constrained or delta neutral optimal portfolio. So these two methods actually input a parameter called the gamma parameter. And the gamma parameter is nothing but it gives us a measure of the risk aversion of the investor. So the higher the magnitude of this gamma parameter is, the more risk averse an investor is. So next, let's look at the results that we have obtained from using this presentation, using this model. So on the left-hand side, we have the results for the optimal portfolio weights strategy. On the right-hand side, we have the results for the delta neutral portfolio weight strategy. And one thing to note here is that you can see that the results are pretty similar to each other, except the y-axis as the values are different. If you go back to the previous slide, here we can see that the calculated lambda values are pretty similar to each other. So as I mentioned before, when lambda 1 is nearly equal to lambda 2, both the strategies converge into one, and they tend to give the same results. And that is shown here. So finally, let's look at the wealth of the total wealth of the portfolio for the optimal portfolio strategy and the delta neutral portfolio strategy on the right-hand side. Again, we can see here that the wealth process calculated for both the strategies move pretty close to each other. And we can also see that we have generated quite a good profit over 2 years by using these strategies, although there are some drawdowns here. So here's the reference paper that I've used for this presentation and for implementing these models. Please feel free to go through this paper if you're interested in this topic. It's a pretty great paper with some pretty interesting results. I had to omit some of these from the presentation in the interest of time. But yeah, interested viewers can go through the paper to gain a deeper understanding on convergence traits using stochastic control approaches. So finally, thank you for listening to this presentation. I hope this was insightful and you were able to gain some knowledge on using stochastic control strategies. So if you have any further questions regarding this, please let me know in the comments.